If you're a Canadian senior, or about to become one, and your income crosses $95,323, the CRA can legally take back part, or even all, of your old age security pension. Every single month, automatically. No phone call, no warning letter before it happens, just a smaller deposit. And here's the part almost nobody explains properly. The number that affects you this year might not be the number you think. There are actually two different thresholds running at the same time in 2026, and mixing them up is the single biggest reason retirees get blindsided. By the end of this video, you'll know exactly what the OAS Clawback actually is, why there are two thresholds in 2026, $93,454 and $95,323, and which one applies to you, how the 15% recovery tax is calculated with real numbers, the exact income level where your OAS disappears completely, and 6 legal strategies retirees use to keep more of their pension. Stick around till the end, because the planning window for this closes faster than most people realize. Let's get into it. What is the OAS Clawback really? Old Age Security, or OAS, is a monthly government pension available to Canadians 65 and older. Unlike CPP, you don't pay into it directly. It comes out of general tax revenue, and it's based on how long you've lived in Canada, not how much you earned. But OAS was designed to support low and middle income seniors, not high earners. So back in 1989, the government introduced what's officially called the OAS recovery tax. Everyone just calls it the clawback. Here's the simple version. Once your net income for the year goes above a set threshold, the CRA starts taking back 15 cents of your OAS for every dollar you earn above that line. Keep climbing, and eventually they take back all of it. It's not a separate bill that shows up. It's not something you write a check for. The CRA simply reduces your monthly OAS deposit in advance based on your most recent tax return and reconciles the exact amount when you file. One more important detail. This is calculated per person, not per household. Each spouse has their own threshold. That single fact opens the door to some of the planning strategies we'll cover later. The two thresholds, why 2026 is confusing. This is where most retirees get tripped up, so let's slow down here. OAS doesn't run on a calendar year. It runs on a July to June payment cycle. That means the income used to calculate your clawback is always from a previous year. There's a built-in lag, so in 2026, there are technically two thresholds in play. Threshold number 1, $93,454. This is the number that applies right now for the payment period running from July 2026 to June 2027. It's based on your 2025 income, so the tax return you already filed. If your 2025 net income was above $93,454, the CRA is already reducing your monthly OAS deposits as we speak. Threshold number 2, $95,323. This is the number in your video title, and it's the one getting attention online. It applies to the 2026 income year, meaning the income you're earning right now, this calendar year. But it won't actually affect your OAS payments until the July 2027 to June 2028 period. It's the forward-looking number, adjusted upward for inflation. So here's the practical takeaway. If you want to know why your OAS deposit changed this year, look at your 2025 income versus $93,454. If you want to plan ahead and protect next year's payments, you need to manage your 2026 income against $95,323. This lag matters because decisions you make right now, selling an investment property, a large RRIF withdrawal, even picking up extra contract work too, won't show up as a clawback today. They'll show up over a year from now, when you've probably forgotten the reason. That's exactly why proactive planning beats reactive damage control every time. How the 15% recovery tax is actually calculated. Let's make this concrete with real math, because abstract percentages don't mean much until you see them applied. For someone receiving close to the maximum OAS amount, that's a meaningful chunk gone for the entire 12-month payment period based on 1 year's tax return. They're still receiving some OAS, but it's been cut by more than half compared to someone under the threshold. Example 3, full clawback. Here's where it gets serious. For seniors aged 65 to 74, OAS is reduced to zero once net income reaches roughly $152,062. For seniors 75 and older, who receive a 10% higher base OAS amount, the cutoff is closer to $157,923. Above those numbers, you're not getting a smaller pension. You're getting nothing. The reason the 75-plus group has a higher ceiling is simple. Back in July 2022, the government permanently increased OAS by 10% for that age group. A bigger pension means a bigger dollar amount has to be clawed back before it's fully eliminated, so the ceiling moves up accordingly. What counts as income for this calculation? This is the part that catches people off guard, because income here doesn't just mean your job or your pension. Things that do count toward the threshold include CPP payments, employer pension income, RRIF, minimum withdrawals, interest, dividends, and capital gains from investments. Rental income, even OAS itself counts toward the calculation. Part-time employment or consulting income after retirement, things that generally do not count, TFSA withdrawals. And this is a big one. Because TFSA growth and withdrawals are never reported as income, you can pull money out of a TFSA and it has zero effect on your clawback exposure. This is exactly why a lot of retirement income planning revolves around sequencing, figuring out which account to draw from and when, so your reported net income stays under the line as long as possible. 6 ways retirees legally reduce their clawback exposure. None of this is about hiding income. It's about timing and structuring it properly. Here are the most common, completely legal strategies. 1. Pension income splitting. Since the clawback applies per individual, a couple can split eligible pension income on their tax returns. Shifting income from the higher earning spouse to the lower earning one can pull both partners under the threshold, even if the household's total income stays the same. 2. TFSA first withdrawal strategy. Because TFSA withdrawals are invisible to this calculation, drawing from a TFSA before tapping a RRIF, especially in years where you're close to the threshold, can keep your reported income lower. 3. RRSP meltdown strategy before age 65. Some retirees deliberately draw down their RRSP in their early to mid-60s, before OAS even starts, to reduce the size of mandatory RRIF withdrawals later, which lowers future taxable income during the years OAS is actually being paid. 4. Timing capital gains. A large stock sale or the sale of an investment property can spike your income for exactly 1 year, and that 1 year is what determines your clawback for the following 12-month period. Spreading a sale across 2 tax years or timing it for a lower income year can soften the impact significantly. 5. OAS deferral. You don't have to start OAS at 65. Deferring increases your monthly payment by 0.6% for every month you wait, up to age 70 watching, a maximum 36% increase. This doesn't avoid the clawback calculation itself, but for some retirees, starting OAS later, once other income sources have already been drawn down, means a smaller portion ever gets clawed back in the first place. 6. Charitable donations and other deductions. Strategic charitable giving, especially donating appreciated securities directly, can reduce net income in a given year, which lowers exposure in that specific tax year. The common thread in all 6 strategies is the same. This is a 1 year at a time calculation, and the CRA only sees what shows up on that year's tax return. Smoothing income across multiple years is almost always more powerful than trying to fix things after the fact. The timing trap, everyone misses. I want to repeat this because it's the single most common point of confusion in the comments on every OAS clawback video. If your income was high in 2025 but has already dropped in 2026, your OAS payments are still being reduced right now because the CRA is using your 2025 tax return for the July 2026 to June 2027 period. There is no mechanism to manually update this mid-year just because your current income is lower. The reverse is also true. If your income spikes this year in 2026, you won't see the impact on your monthly deposit until July 2027, a full year and a half from the income event itself. This is exactly why one-time events, means selling a property, a large investment gain, even an inheritance that triggers taxable income, deserve planning before the transaction, not after the letter from the CRA arrives. Once a recovery period is finalized, it generally cannot be changed retroactively, even if your income falls dramatically the very next year. Wrap-up/call to action. So to bring it all together, right now, in 2026, the threshold sitting on your OAS deposits is $93,454 based on your 2025 income. The number in this video's title, $95,323 NAS, is the threshold for income you're earning this year, and it will determine your OAS payments starting in July 2027. 2 different numbers, 2 different timelines, same underlying mechanism. 15 cents of OAS lost for every dollar above the line, until it's gone completely somewhere past $150,000. The good news is that none of this is set in stone for you personally. With the right sequencing, TFSA withdrawals, pension splitting, smart timing on big transactions, many retirees keep significantly more of their OAS than they would by doing nothing. If this helped clear up the confusion, drop a like, and let me know in the comments which threshold actually applies to your situation. I read through them, and a lot of future videos come directly from your questions. Subscribe if you want more breakdowns like this on CPP or RIF rules and retirement tax planning. See you in the next one.